In this week's update, will the rotation away from tech continue? Where are the most assured future returns? And as always, we'll take a quick peek at the Bitcoin chart. My name's Garry Davis, and as always, this is general advice only. And please remember to subscribe and like to the video. All right, let's start with the normal bigger picture perspective on the market. When you read through a lot of commentary, as I do during the week, you can just sense that all the bears are out in force again. They've been willing this bull market to finish for years and years, and they're hoping this will be the top again, with a lot of disruption, a lot of high growth technology stocks being sold off. But look, I can tell you with a high degree of confidence that sadly that's not going to be the case yet again. I think this is going to prove to be just a temporary rotation, a burst of profit taking, which is normal. So the high growth stocks that people have done incredibly well out of, there's profit taking happening, and that money is going into value stock areas. It has to go somewhere. It's not necessarily going into value stocks because they're the most wonderful buy. It's just that is where the rotation is happening at the moment. But I think this rotation will reach a natural conclusion soon enough, and we'll go back to growth and great buying opportunities in the tech stocks. So let's just quickly look at what is needed for a major top. These are the things that are almost always need to be present for a major top to form. We need sufficient inflation to force the central banks to raise rates. Now, we're not even close to that at this stage, and we saw two reports through the week in the US, the CPI on Wednesday night and the PPI on Friday night, and basically they were pretty much in line with expectations. So despite the fact that the bond yields are moving up at the moment, they're doing it in anticipation of inflation rising, not the reality of inflation rising at this stage. Now, that could change, but the reality is at the moment that we don't have that. And central banks have said, we want a minimum of 2% inflation, and we're prepared to let it go higher for longer. So where the inflation figures are at the moment at under 2% is not even close. So the bond market is just trying to anticipate the future. And history of the last 10 years would seem to indicate that inflation has been pretty well contained. The next thing that you need for a major top is you need really, really bullish sentiment. You need everybody to feel so confident that prices can only go one way that you've got no real marginal buyers left. Everybody's all in, and we certainly don't have that. We need a far smaller gap between the 10-year bond yield and the earnings yield for stocks. Now, at the moment, the earnings yield for stocks on average is around about 5.5%, 6%, and the bond yield is 1.6%. So that gap is still far too wide. Stocks are still offering a far better deal than the bond market is. The next thing we need to be past the peak in economic expansion, and we're only in the early stages of a massive global expansion. So we've got years to go yet in this expansion. It's just getting started. So that certainly doesn't apply either. So none of the circumstances for a major top are in place. And that's why I think this secular bull market continues for a lengthy period of time from here. So what is the reality of what's going on at the moment? Now, I covered this in part last week, but I'll just add a few more things to it and just recap again. We've got strong economic growth around the world. The US, Europe, wherever you look, there's strong economic growth because of the stimulus and the recovery from the COVID shutdown. We've got very high consumer cash levels, with so much money being injected into the system in various ways being given directly to consumers. There's a lot of cash. And also there's a lot of pent-up demand to spend big. People haven't been able to get out and buy things. They haven't been able to get out and travel. There's all this pent-up demand and high consumer cash levels, and they're going to spend it. The next thing is we've got low interest rates, and whilst interest rates are moving up, and yes, they've the 10-year bond yield has trebled from 0.5 to 1.5 in the last 6-8 months, they're still, by normal standards, they're still extremely low. And we've got really accommodative central bank policy, whether you look in Australia, where the Reserve Bank has said, it's going to be at least 2 years before we think about raising rates, and possibly longer. And the Fed's saying something similar. So we've got very accommodative policy. We don't have tightening at all. And central banks will hold off as long as they possibly can. We've got a massive global infrastructure build. In America, it's desperately needed. It's probably a couple of decades overdue. And of course, the stimulus to the economy to get things going again is a perfect excuse to do massive infrastructure building. And that, to a degree, applies pretty much around the world. And once governments get past the immediate urgency of fixing the consequences of COVID, then they'll certainly turn their attention to that global infrastructure build. And that's just going to be a massive stimulus. What is keeping inflation in check is, this has been the case for at least a decade, is that we've still got spare labour and spare product capacity. Now, technology has played a part in that because things are just manufactured more efficiently these days. But also, the unemployment rate spiked up a lot, particularly in the US, due to COVID. And whilst the unemployment rate has come down, it's quite a bit, but it's still around about the 6% mark. So we've still got a fair way to go to get to the sort of unemployment levels that would lead to inflation. So I think, that's why the inflation thing has been a bit overblown in the media. We've also got, because of all of what's I've got above, is we've got record earnings growth. The earnings growth in the December quarter was really extremely strong. And companies are coming out and raising future guidance where they don't need to. CEOs are going out on a limb, so that gives you an idea of how confident they are about the future earnings growth. So that is the reality, and just a couple of final points on that. Now, we're seeing this rotation into value stocks, and that's just part of the normal cycle of the market. We get one part of the market advances really strongly, reaches a peak, perhaps gets a bit overblown, and we get some profit taking, and that money diverts into another part of the market, and that runs along for a few months until it runs its course. That's just the normal cycle of the market. Now, some value stocks do warrant higher prices, particularly in some of the consumer discretionary areas. But most so-called value stocks are actually in danger of future disruption. Now, it may not be this year and it may not be next year, but it's coming. And any stock that is not essentially a disruptor of some sort is at risk of being disrupted. And what's going to happen is that business models are going to fall apart far quicker than they ever did in the past, because that's just what's happening with technology. So if you're starting to embrace value stocks and looking to divert a significant portion of your portfolio from growth stocks to value stocks, just be very careful with doing that, because I think this is a shorter term rotation, and what you'll be doing is to try and remove some of the pain that you've felt of owning growth stocks in the short term. You're at risk of putting money into stocks that are going to be in trouble in the future. So just be very careful with rotating your portfolio too heavily towards value stocks. Now, I'm not saying that there isn't a place in your portfolio for value stocks, but just keep it all in perspective. The next thing is that sentiment is just so far away from being all in, it's not funny. People are nervous. The VIX is still above 20. It's been up to 40. It seems to be taking less and less events to push the VIX up into the 30s. So the market is very, very nervous. So sentiment is just nothing like what you see at market tops. We've got, as I covered last week, we've got a huge amount of institutional money on the sidelines that's come out of the bond market, and it will eventually find its way into the equities market. And this little pullback that we've had is just the sort of circumstance that institutional money is looking for. And just a couple of numbers. This is courtesy of Shane Oliver in the last day or so. Cyclical bull markets going back to World War II. There's been 12 of them. In the US, they've averaged 64 months in length. In Australia, they've averaged 46 months in length. The current one we're in has been going for about a year. So you can see in terms of time, we're not even close. And also in terms of gain, we're not in percentage gain, we're not even close. So all of those things and the environment is just completely and utterly wrong for a market top. So I think you can dismiss any of those sort of reports that you might see, and just stay focused on the most productive part of the market, which is growth and megatrend stocks. Now, yes, they're volatile, and that makes it a bit more difficult, but that doesn't mean that you should abandon them. Just finally on this sort of general comments, market dynamics are playing a part in this extreme volatility. There are things going on there that have amplified the size of the volatility, and I guess everybody is aware of the Reddit traders and the Robinhood traders, and the vast majority of these people are very inexperienced. They're driven by social media. In some cases, they're using leverage. And I'm sure that part of what we've seen in some of these high-flying sectors that were subject to a lot of social media hype and a lot of speculation is we're seeing that people are being panicked out, being forced out, and that process just takes a little bit of time to play out. So I think that's part of it. The other part of it, I think, is just some of the dynamics around it, particularly around ETFs. Oil has done really well, and oil stocks have done really well of late, and some of that money has sold out of some of the renewable energy, some of the solar energy stocks. And once you get selling start in a particular ETF, and I'll show you one of those ETFs, once selling starts, then it becomes a bit of a self-propelling mechanism until it runs out of momentum to the downside. So a bit of selling means that the ETF manager has to sell stocks, and that causes more selling, which then requires the ETF manager to sell more. And so it feeds on itself and it spirals down. And if we look at, let's just look at one of those charts. I'll come back to Bitcoin. So let's look at TAN, which is an ETF for the solar sector. So this is an ETF covering solar stocks. So you can see that we had an incredible run from sort of $30, $40. We got up to $120 or just over, and that was in January, and then we've had this sudden pullback to 80. So it's given back 33% of its value. Now, I would like to bet that part of that is just this self-propelling spiral to the downside that eventually will have run its course. Whether we've seen the lows in this or not yet, I can't say at this stage, because we're still falling quite sharply. We've had a bounce, but we could go down lower yet. But it's that market dynamic that just feeds on itself, and one causes selling in the other until it reaches a new equilibrium. Now, just before I forget, let's just look at the Bitcoin chart. So over the last couple of weeks, I put here, because Bitcoin had got ahead of the trend, ahead of the 20-day and 50-day moving averages, I suggested that we could see an ABC correction where we would get a bounce to a lower high, and that looked like it was playing out the week before last. And then we would come down and we would perhaps test this breakout around $40,000. Well, that didn't happen. we got a slight pause, and then now we've gone up again, and we're now at a double top. So it will be very interesting to see what happens with Bitcoin around this double top. Will this break? Will it be a false break and then fall back into the range? This is just from a purely technical point of view. So this is not about Bitcoin. This is just any other chart. This is an extremely difficult chart to trade. And if you're using normal risk and reward parameters, you certainly would be thinking about taking some partial profit at this level, because yes, it might break out, but this could prove to be a double top that causes a bigger pullback. So I would encourage anyone that is active in Bitcoin. I'm not, but anyone that is, don't get too carried away with trying to make too much profit. Just look at it from a risk and reward point of view. All right, so what does the smart money do at times like this? Well, look, it's just sitting back and waiting. They're waiting for all of these market dynamics to play out for us to reach a new equilibrium at a lower level, and then you're going to start to see the smart money moving back into the market. And they're going to be buying the stocks that have got highly probable future growth. And, it's success in the market is not a lot more difficult than just doing that. Now, the discipline around it is another thing. It requires a lot of discipline to sit back and wait. But that's the way to play it. All right, let's turn now to American stocks. The S&P rose 2.6 across the week, and set a new all-time closing high. But the Nasdaq, reflecting the sell-off in tech stocks or the rotation, actually fell 2.1%. So a very large difference still between the main part of the market and the technology growth part of the market. But the VIX did slip back to 20. So let's take a look at the VIX. Okay, there's the VIX index. So you can see we on the 4th of March, we did have a bit of a spike into the high 20s, but we've settled all the way back down, and we're almost back down to the lows that we've seen over recent months. And if we take that out, let's say to 12 months, that gives you a better idea of where we are. So the VIX is actually tracking along at a relatively low level at the moment. So certainly things at that level are settling down. It's just we've got some high volatility in some parts of the market, and that may not have finished yet. It's really hard to know. The US dollar slightly lower, not much, but down to 91.68. But the 10-year yield, despite the fact that the inflation reports in the US were okay, they were pretty much on expectation, that yield is still edging up to 1.63. But look, there's a lot of commentary and a lot of analysis on this at the moment, and I guess the consensus from sources that I would think are pretty credible reckon that the 10-year bond yield is probably going to struggle to get above about 2.5%. And that really is still pretty low. And it's really only where central banks want inflation to go to at least 2 or 3%, perhaps even 4%. So I think this high yield is just reflecting the really high growth levels that are expected in the economy and in earnings. All right, let's take a look now at some other charts. Okay, so let's start with the normal spread charts that I look at. So we'll start first of all with the consumer discretionary versus consumer staples. You can see the consumer discretionary did a little bit worse, but only for a very short period of time, and now it's picked back up again. And consumer discretionary is actually in the States is looking really quite positive, and that's certainly an area that I'm looking at for opportunities. This is the Russell 1000 growth compared to the 1000 value stocks, and you can see that we haven't turned around yet. I think it's probably safe to say. We may not be too far from a low. If you look at these peaks and troughs down here, we may be close to forming a bit of a stable base in terms of the relationship between these two sectors, but you couldn't say that we've turned around yet. So we still need to take some care with growth stocks. But look, these are just overall averages. Now, within this, you're going to find growth stocks that have already bottomed out and have turned around very nicely. So it's still very much a specific stock picking market. If we look at the S&P, you can see new all-time closing highs. We did get a slightly higher reading on Thursday, but in terms of closes, we closed at 39.43, and that's a new all-time high. So looking very, very robust. The Nasdaq, however, it's below the 20-day, it's below the 50-day, and the 20-day, in fact, has rolled over. So yeah, perhaps we need a bit more basing action in the Nasdaq. But small caps are still barreling along really nicely, and the Russell 2000 for small caps hit a new all-time high, and that's looking extremely positive. Now, just turning to currencies, the US dollar, you can see we are forming higher highs and higher lows. So there's probably, there's no doubt that from a purely technical definition, the US dollar is now in uptrend with higher highs and higher lows. It's a bit early to say how quickly this is going to move, but that's where the trend stands at the moment. And the Australian dollar is doing a little bit better comparatively because we've got the influence of high commodity prices. So just while I'm here, let's take a look at the Australian market. So the ASX 200 finished at 67.67. It was up slightly on the week, but really hasn't done a great deal pretty much all year. It's roughly at the same level that we started the year at. And if we look at some of the individual setups, so this is materials. So the BHPs and the Rios and the Fortescues and those sort of stocks, we've dipped just below the 50-day, and it was been a little bit weaker in the last week or two, but generally not doing too bad. Healthcare has taken a fair whack, so the likes of CSL and ResMed and those sort of stocks have been under selling pressure. But I think that's just a valuation thing, and we're just getting a bit of a cyclical rotation in the Australian market. But certainly healthcare has pressured the ASX 200. But it's finance that's done well, and you can see it by the orientation of the moving averages. So just go back and look at healthcare, where the price is relative to the blue line and the red line, and what those lines are doing. They're now rolled over. But we look at the finance sector, and you can see it's quite the opposite. So strength in finance as bond yields rise, which is normal, has led the market. Energy has been sort of in the middle. We had a little bit of a gain, but now it's just been going sideways. So that's the Australian market. So just to recap, we closed at 77.28 on the currency, and the index was up 0.8. Now we are seeing some consolidation in the battery materials stocks and resource stocks, but equally we're seeing a lot of volatility and a lot of extreme moves in resource explorers, which is really a bit strange. The point I'd make here is if a 50% decline, which we've seen in some of these really volatile stocks, if a 50% decline after a 300% gain is a problem for anybody, then your game plan requires some work, quite frankly. You can't have the 300% gains in 6 months or 12 months and then not expect a 30, 40, 50% decline. One just goes with the other. So if you want to be in the part of the market that's offering these really, really high returns, then you've just got to recognise that you've got to have a game plan that allows you to live with it. And that can be done. And we certainly do a lot of that in Portfolio Analyst. Now, precious metals, gold was higher, so it's really just a bounce back from the very heavy selling in previous weeks. So gold managed to scramble back above 1,700. Silver also rose again, not quite back to $26. And we've got this really unusual dynamic in the Australian market where gold producers are struggling. Stocks like NST have been sold down quite heavily, and others, while we've got explorers and companies that you would regard as quite high risk are absolutely surging, and we're seeing some very big percentage moves on a day-to-day basis. So it's rather an unusual market in Australia. There's a lot of speculation happening, that's for sure. Okay, let's just check out gold and silver. So we'll start with silver first of all. So silver is really just in a bit of a sideways pattern, and is sitting at the same level that we were at in August last year. So a big surge in silver, and then essentially it's just been a bit of a volatile band sideways. There's gold on a weekly chart, so you can see we're clearly in downtrend. There's no question about the fact that we're in downtrend. Have we hit the bottom? Have we bounced off this 38.2%? Or is it likely to go down another leg down into the let's say the 1560s, 1570s? You'd have to say at the moment the probability is that gold is probably going lower. Now, whether it does or not, we'll have to wait and see. But that's how the probabilities look at the moment. And if we look on the daily chart, there's nothing really to get excited about. This is just a normal bounce from oversold. So I wouldn't be at all surprised to see gold edge down further again. Sorry, wrong one. Okay, turning to other commodities. Copper up a little bit to $4.13. And that's really just a currency effect, just the US dollar coming off. Nickel, however, slipped further, so it's 2 weeks in a row that nickel has slipped back. And I think the only way to really play these markets is just keep focused on the long-term trends and the quality businesses within the long-term trends. Just be careful you don't overweight your portfolio too much in a lot of these speculative stocks that are getting a lot of attention from brokers and newsletter writers. We're seeing extreme moves in some of these stocks. We're seeing some moves of 50 and 100% in a day, in a few hours. So just be wary of getting overweight in a lot of these speculative stocks. It's okay to have some of them in your portfolio, but just don't get a whole wheelbarrow full of them. Crude oil edged a bit lower after being up in the 66s during the week, 65.61. There are quite a number of geopolitical elements in the price movements at the moment, so I find crude oil incredibly difficult to understand where the price is going. There's the spot copper chart, so clearly there's a very, very powerful trend there, and that's what we should be focused on. Nickel is also trending up, but we are getting a more significant correction back in nickel, and that's what's pressuring some of the nickel stocks at the moment. All right, just to wrap it up, my final thoughts on the market and what to look for. From my perspective, I believe growth saves you from potential pitfalls in the future. Stocks that are going to be disrupted, I don't want to be anywhere near, because we don't know how quickly that's going to occur and how quickly it's going to affect the share price. So for me, I'm staying with the probability of highly assured growth. And what I'm looking for is stocks that, whilst on the surface they might appear quite expensive, the market is looking a few years out with these stocks. And if the revenue growth and the probability of that growth is way higher than the current multiple, then, to me, that's a prospect that's worth taking. And to give you an example, let's look at a stock that's perhaps trading on what would seem to be a high revenue multiple of, let's say, 20 times. And that, in absolute terms, is expensive. But if that company is growing its earnings at 50, 60, 80% per annum, which a lot of these really high growth companies are, then that revenue multiple in 2 years' time comes way down into single digits. And that's what the market is looking at. And if you want to look at a stock like BHP, for instance, just as an example, now BHP trades on 4 times revenue and 8 times EBITDA, which is your first level of profitability. So if you've got a high growth stock that's growing at 50, 60% a year plus, and you're paying 20 times revenue now, but that becomes 7 or 8 times revenue in 2 years' time, then, I don't find those stocks overvalued. So look for the ones, there are some stocks that are just at outrageous multiples of sales, but look for the ones where that isn't the case and buy them. Don't just abandon all growth stocks because some are over extended. Now, when you are in these high growth stocks, you have to accept the high volatility. As I said before, it's unavoidable. You can't have one without the other. But I would just pose this fairly obvious question. What would you prefer to own? Do you want to own the stock that is going to be disrupted and perhaps have their business model fall apart in the future? Or do you want to own the disruptor? I think that's the sort of market that we've got into the future. And I've been talking about the fact that I think the market is going to split, if you like, into the stocks that are going to do extremely well and all the rest that are going to struggle. And I think that's the choice that investors face in the future. Do you want to be the disrupted, or do you want to be the disruptor? And to me, the answer is pretty obvious. And if you decide to go with the higher volatility disruptor kind of stocks that race up in price and then give back a significant amount, then what you need to do is to devise a game plan that you can live with the volatility. That can be done. It's just all about how you structure your entries, how you structure your partial profit taking. Now, portfolio analysts last week, we certainly did quite a bit of strategy, and every week it happens, strategy around entries and exits. I think there's a great deal to learn about how to engage with the market more successfully in that service. So I'd recommend, if you haven't taken the $1 trial, then I would suggest you should do so. There was also reviews of the portfolios last week quite extensively, and this week we've obviously got another set of data to look at where those portfolio stocks are sitting. So that's it for this week. There's my contact details and more information on the website if anyone would like it, and I'll be back with you next Sunday. Cheers.